Hi guys, and welcome to this video for VCE Year 12 Economics. This is part of Unit 4 Outcome 1. We are focusing on monetary policy, and it is the final video of monetary policy, and hence we are going to think about, now that we're experts, the strengths and weaknesses of monetary policy. Should be a pretty quick video. You can see that it is the final key knowledge point, so there is a significant amount of assumed knowledge as I discuss this. I hope that you understand what monetary policy is, how the RBA alters interest rates, how this flows through to aggregate demand and inflation, and the history of the last, particularly 2 years of monetary policy in Australia. Here we're going to think about what are the strengths and what are the weaknesses of monetary policy. And when I think about strengths and weaknesses, I'm always going to come back to how effective is monetary policy in ensuring Australia meets its macroeconomic goals, and we know what these goals are. We talk about them all the time. I won't even write them down. Strong and sustainable economic growth, full employment, and low inflation. And we want these goals to be achieved because the main goal is to improve our living standards of our citizens. So monetary policy, quick recap. I hope this is not new. This is pure revision. It's all about the RBA controlling interest rates to manage inflation, which will make it within our target range of 2.3%. And we know that if we have inflation between this range of 2.3%, we have the best chance of having strong growth, full employment, and good living standards. So what is the strengths of monetary policy? Monetary policy is really effective at restraining aggregate demand. So if inflation becomes above 3% during booms, it is really effective, as tightening interest rates will immediately reduce the discretionary income of households. Households that are in debt, have loans, will almost immediately realize that they have to pay more on their loans and they'll have less for consumption. There is a strong influence on economic agents. And what I mean by that, the RBA makes its reasons for decisions clear. They release their minutes from each meeting. And this means, because the RBA is independent, trusted, unlike budgetary policy where the weaknesses were that it's quite political, this RBA is independent. This means it has a great lot of influence on parts of the economy: consumers, investors, borrowers, and lenders. They are making statements of what they think is going to happen in the economy, what they're going to do in future. They are trusted. So sometimes the RBA governor, essentially the boss of the Reserve Bank, can make statements without actually changing the rate. And this will influence behavior. They might indicate interest rates are going to go up unless this happens in the economy. And just saying that might influence the economy. Generally, the implementation lag is quite short. Once the RBA announces its cash rate decision, it works in the overnight money market quite quickly. They're able to manipulate the cash rate quite quickly. And because the financial institutions trust the RBA, it's a credible system, they almost automatically adjust their interest rates once the announcement is made. So if interest rates go up, the banks announce their interest rates going up pretty quickly, and that can almost immediately impact interest payments. One of the major strengths also is it is free from political bias. Monetary policy is implemented by the RBA independently from government. Only in exceptional circumstances will the government interfere. They don't, essentially, in Australia. And so free from political bias, during the recent 2022 election, the RBA rose interest rates during the election because they felt that they had to, and both parties really had no ability to change that, particularly the government in power. This was a bad thing for them on the eve of their election, and they had no ability to stop it. Now, what are the weaknesses of monetary policy? Many people would say that it is a blunt instrument. It is one-dimensional. Monetary policy just rises interest rates or drops interest rates. It can't target a particular group or sector, unlike budgetary policy, which can put specific programs in place. This means the rate decisions impact everyone the same. Now, we are in a situation where rates are rising and some parts of the economy are really struggling. So to have an interest rate rise as well is a blunt object. There can be a time lag. While the implementation is quite quick, there can be a time lag until the full effect of cash rate decisions is felt. And so, for example, because if you raise your interest rates, you still only pay them once a month. So the first couple might not really impact you too much. So this might mean the monetary policy works in the opposite way it's intended, because we're still feeling the lag 18 months' time when actually the economy might have changed then. Now, another impact weakness is even though the RBA has significant impact controls the cash rate, they have no direct control over interest rates. And while it does flow through to other interest rates, banks sometimes will not pass on the full reduction in the cash rate, or they might pass on more of an increase than what has been risen. And that's because the bank will get their cash from different sources, and these impacts their costs as well. So it's not always, for example, the cash rate rising by 50 basis points. They then have to rely on the banks to do something similar, especially when they're trying to expand the economy and dropping interest rates. So let's say they dropped interest rates by 0.25% or the cash rate by 2.25%. That hasn't always been passed on in full. Now, private sector debt is a weakness. We know that the private sector, household, business have high amounts of debt, particularly because houses are so expensive. And this means that they are less likely to borrow more, even if rates are low. So if we have an expansionary monetary policy, we're trying to drive aggregate demand because there's not a lot of growth, inflation is low. People might still be hesitant of getting interest rates because they've already got lots of debt. So we might say that the strength of monetary policy is it restrains aggregate demand. It's not always effective at increasing aggregate demand. And this is what we're saying here. During downturns, lower interest rates are less effective at spinning up the economy because often there's other factors at play. Confidence is low. So the ability to get more loans and get them cheaper because of a drop in interest rate isn't something that consumers and businesses are likely to take an advantage of during a downturn. They might just use that extra money to pay down their debts. So it's not even increasing spending. They'll just take advantage of a little bit more money in their wallet to pay down their debt. Also, the RBA really has no direct ability to reduce inflation that is due to cost inflation. So remember, higher demand can lead to higher inflation. But if there's supply factors impacting the cost of production, this will also increase inflation. And this has definitely been happening at the moment due to supply chains issues, COVID, lots of reasons why cost of production is rising. Now, monetary policy is not that effective at impacting supply. So they're going to have to address that and understand that really monetary policy is only effective at addressing demand inflation. So I hope this gives you a good summary of the strengths and weaknesses of monetary policy. And this is our last video in monetary policy. And I hope that you're leaving really understanding what monetary policy is, how it is used by the RBA to really help Australia achieve its domestic macroeconomic goals and hopefully increase material and non-material living standards of Australian citizens.